All right, we are live. Welcome back to the channel, Crypto Trend Trader, with our Sunday evening market look ahead. It is 8 p.m. Eastern Standard Time on March 20th, 2022. And before we get started, I would like to remind you this is not financial advice. I am not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So we got a big week ahead. Big week ahead. I don't think too many people realize exactly how pivotal it is. So we had a pretty strong close into last week in the stock market. We were actually having a small discussion in the group about the triple witching futures. So could have seen quite a bit of short covering and some, spot market movements as well after some pretty aggressive selling that has lasted for quite a while now. Would not be unrealistic to see an aggressive bear market rally. And obviously, more often than not, like we discussed over and over again, in a bull market, we take the stairs up and the elevator down, and it is vice versa in a bear market. We take the stairs down, just slowly grinding, and then all of a sudden we have aggressive move back up. Just, basically trapping people in a short position if they're late to the party, or not allowing people to buy in if they are, late for the bounce. And then next thing you know, they FOMO into the bounce and then it rolls over. Now, is it possible that we have already bottomed out and we're headed up to new all-time highs and it's game on? It 100% is. But I think the most important thing is to just focus on the trend, not the short-term move, and pay attention to the actual technicals. Even if you want to pay attention to the fundamentals, pay attention to them and see, did anything actually change? And whatever changed, did it change for the positive or for the negative? What's going on, Mr. Lex? Let me know you can hear me loud and clear in the chat. Welcome to the stream. And in the meantime, we're going to go ahead and get this party started. And if you are not familiar with the Four Horsemen, as the stream title and picture represents, that is the term I use for essentially the indication of a incoming recession or depression. And essentially the four indicators, three of them tend to trigger in general. And then the fourth one, when it triggers, usually leads to devastation, aka the apocalypse. Not the end of the world, but typically some serious pain in the markets. So we have a top in energy, a top in transportation, a top in semiconductors. We have yield curve inversion. And then the fourth horseman is the energy spike. And when we see a big spike, not only does that lead to a recession, but it leads to essentially like a strong recession, serious damage to the markets, like what we saw at pivotal moments in time, like 2000, 2008, the serious market or world events. Appreciate you, buddy. All right, so let's get rolling here. So obviously we had, and we'll take a look at each of those individual components along the way. Here we have the TNX. Obviously had a nice little spike to the upside. It's still inside the bullish control zone. All green histograms still well above the slope line. Starting to cool off a little bit on the daily. The weekly close was, pretty aggressive. Obviously had a gap up to the highest level, cycle high. So still very strong. Very much inside the bullish control zone on the weekly. All green histograms. Looks like it wants to, very close to flipping the slope back over on the TJD, TDMACD, back to blue and strengthening to the upside. We now have the 200 exponential angle to the upside after acting as resistance twice. Came back down, retested as support, and then just shot off to the upside. And now the 200 simple is still slightly sloped to the downside, but definitely flattening out. So if we maintain for any amount of time above 1.75, this will flip over blue as well. And we will have the 200 exponential and 200 simple blue, indicating that on the weekly Treasury yield on the 10-year, we're in a bull market. And the last time we entered into a bull market was confirmation, basically back here in November of 2016, where we were at 2.166%, very similar to where we're at right now. And then that led to a peak of 3.23%. And that lasted from November of 2016 until, basically the peak was here in October of 2018. So about 2-year bull market. So if we're seeing a similar situation here and we come back down, get the retest, and then we go into a 2-year bull market from the exact same level we entered into, basically the bull market previously, maybe we make it up here to like 3.1 and then we top out and it's just too much for the markets to take and we put in another lower high. That is definitely a possibility. Definitely a possibility. And we just keep kicking the can down the road. Definitely a possibility. And then when we look at the 200 exponential, we see that comes in on the monthly. 200 exponential and simple comes in about 2.7. So that would be a slight push above that level. Maybe we don't make it up quite as high. Maybe we hit those and top right out. But we see here momentum-wise, we're very much in a bear market since, obviously, I don't have to tell you. We entered into a bear market in 1989 in treasury yields, which means we were in a bond bull market. So from 1989, so we're talking about, 32, 33 years in a bear market. And now we're seeing we exit the bearish control zone, hard buy signal. Indicator number 1. Enter the bullish control zone. So that is as bullish as this gets on the stochastics on the monthly. On the TJD TDMACD, we have 2 green histograms in a row. We cross above the slope line, we cross above the 0 line, and then we flip the slope line over blue. That is literally as bullish as it gets. And now here on the TJD master, we have the 8 and 21 on the monthly. Cross to the upside, cross back down, hold support, and then cross to the upside again. And we see something that takes place, an aggressive move to the upside. Now, granted, we still have 11 days left in this monthly candle, so anything could happen. But this is, the biggest, most aggressive move we have seen. It was similar to this one, but this is the most aggressive move we've seen since our bottom back here, in basically the Rona dump. So we have the 821 cross to the upside. The next thing to do is to come up here and retest the 200 exponential and simple. Now, maybe we get rejected, we go back down, that's fine. But keep in mind, that's at 2.7% on the monthly. So that's another, 60 basis points to the upside, 55 basis points to the upside. So what does the market look like with another 50 basis points, 55 basis points? We'll have to see, but we already know with the yield curve inverting on the long end, all the way down to the 5 and 10 are now inverted. The only thing left now is the 210 and, the 3-month or overnight rate. So at this point in time, we've all but inverted the short end of the yield curve as well. And we know that leads to recession. And we'll take a look at that briefly when we get there as well. But, that's 2.7%. So at that point in time, we come up here, we get rejected, and we can say we'll have one negative thing. So the only thing we're missing on all 3 of these indicators, on price action, on everything that determines the overall trend, is on the monthly, we have not yet crossed above the 200 exponential and simple, and we have not flipped them to the upside. But they're not, I wouldn't say they're flat, but they're flattening out for sure. The slope on them is, it's not a flat line, but it's very close to a flat line. It's definitely decelerating to the downside. So it's still angled down, but is it angled down by much, or is it basically flat? Because when I look at this, I see a basically flat 200 exponential and simple. So by the time we get up here to 2.7, that's going to determine the macro trend on the monthly. And if we end up on the upside of this trend, if we end up breaking out of this downtrend, we know what that means. We've discussed it countless times. I don't have to remind you guys. We see this pattern over and over again. A clear downtrend. And when we break out of the resistance, whether it's the 200 exponential and simple moving average, or whether we use our drawing tools and we look at the actual channel here in blue, which we're basically near the top of right now, whether we look at the Fibonacci internal retracement, which we've pushed up to the 618 here, and the 786 just happens to line up perfectly with 200 exponential and simple, whether we turn on log scale and we look at, our basically widening channel, however we want to do this, however we want to look at it, in this case, we're at the top already. It's basically pointing to the same thing, a retest of that key trend line and potential break after, 30 plus years in a downtrend. Now, I'd like to give favor to the predominant downtrend. So on a monthly, I think we get rejected and go back down, just because that's what's been happening. We've been in a downtrend. Every time we try to push up, we got rejected. We went down again. So maybe we go all the way to 0 on the 10-year. I don't know. Maybe we go negative. Who knows? But last time we saw this happen, it was 2 years and an aggressive push to the upside. And that's going to be a lot of pressure on bonds. And we know what that means. That money is going to go somewhere. We just got to position ourselves accordingly to make sure that we're in the right place before it goes there. But with the yield curve inverted, where we know where it's not going to go. When that money comes out of the bond market, we know it's, people are going to be looking for quick opportunities, short term. They're more likely to look for, safety, as there's volatility in the markets, over, quote unquote, going out the risk curve, looking for those more aggressive gains. So let's take a look at oil next. What's going on, Eli? Good to see you, brother. Yeah, glad you made it as well. Asotos, hi. What's up, brother? Good to see you. So U.S. oil. So we had our spike top, came back down, did not hold support, and then we actually got a nice bounce so far. We were able to avert the 8 and 21 cross to the downside, which is definitely a positive sign. And we're now coming up here to retest that key Fibonacci level. So what we really need to pay attention to, we still have the blue slope, but we had lost it as support on the TJD TDMACD. So typically what will happen is we'll come back up and we'll do something like this. We lose support, we try to move back up, we get rejected, we go down. We lose support back here, same exact thing. We lose support on the blue slope line, we come back up, we get rejected, we come back down. Here we don't see any kind of reaction at all when we lose support, or alternatively, here we lose support and come back up and actually reclaim it and then put it in a lower high and get rejected. But we see the last few times we had that same signature. We came back up, got rejected, rolled over. Came back up, potentially get rejected, roll back over. So we'll see what happens. Here we had the spike top already. Does that look like the blow off top? Does that look like, an energy spike, as I like to refer to it? And then also, depending on, obviously we entered into energy, and I was extremely bullish on energy back here. At this point in time, oil is up 213% from when it confirmed into a daily bull market. 213%. So we know that when oil goes up roughly, or energy spikes 50%, it typically leads to a recession. And we know when we see like a spike top, blow off top, or a parabolic, move in energy. Let's go to our chart that I hate real quick. So we're just going to scroll out here, and I'm going to talk about these specific examples that I have talked about countless times, just as a reminder, as we do have some new people. We see these spike tops occasionally. We see one right here in 1990, a clear spike top on energy. And, leading up to that was basically 140% on oil. We see a, aggressive spike top here after, basically a dump or capitulation move in 2000, 214%. We all know that was obviously the dot-com bubble burst. We have a sell-off right here, and then we see a spike top in our all-time highs in 2008 in oil, and that's, over 170%. And obviously that was the global financial crisis. Again, we see a aggressive sell-off, and then we see a push back up from 2016 to the end of 2018. And obviously we know what that was. That was the end of, the move prior to the Rona dump, another 193% to the upside. And then obviously we see the Rona dump, and then that actually confirms us out of the breakout, which was the previous high in 2008. Then we topped out again in 2014. Then we topped out again in 2018. And then obviously we got our breakout right here, and we're macro, extremely bullish on energy. And keep in mind, nobody wanted anything to do with energy since 2008, because it's just been a dog. I mean, it's just been an absolute dog. And since that point in time, obviously with our energy spike right here, and we're going to take a look at it a little closer without the drawing tools, that was over a 100% move there. So now I'm going to turn off the drawing tools, and you guys know our target on energy has been for how long? The 886. And we expected to hit extreme resistance at the 886. Which is exactly at, basically $107, $108. My target was 114. Let's turn off the drawing tools now and look at what's going on here. I mean, now granted, We still have 11 days left in the month, but this is a pretty strong rejection. So if we close like that, if we close anything like that, it's going to look like a spike top. Now, does it have to get rejected and go lower? No, we could easily move back up here over the next 10 days and close at the highs and then be at new all-time highs and keep moving to the upside. Again, we're not looking to call the tops on this thing, but what we are looking for is confluence between the previous times where we saw the same situation happen. And if we just scroll right over here, we see we're still inside the bullish control zone, but the stochastic has crossed the downside and we have a hard sell signal on the monthly. We see the last time the stochastic crossed the downside and had a hard sell signal on the monthly, we left the bullish control zone. That was, obviously we can see all these tops corresponding with our top right here. And then that led to that, the Rona dump over the next, couple years. Keep scrolling back here. We see that, this was our big sell and then continued to break down here. We see the hard sell right here at the absolute top of 2008 led to a pretty aggressive spike to the bottom. We see the hard sell right here led to an aggressive spike to the bottom. Now, sometimes we'll get a little chop area like this where we'll get a bunch of buys and sells in a row. And, we might even get a false signal and then it goes to higher prices. That's definitely a possibility and completely viable. And, if you start looking at fundamentals and you say, okay, does it seem like maybe we get a false signal here, chop around for 6 months, and then nothing gets fixed, nothing gets better, and then we just end up at higher prices? I mean, I would say, yeah, it seems likely to me. I mean, this looks very bullish to me. We have reclaimed the 200 exponential and simple. We lost the 200 exponential back here in 2014. We lost the 200 simple right here, and then it actually never really crossed bearish until right here, just that Rona dump. Just for basically 2 months, it was bearish when oil went negative. And then we had one slight little spot where it was bearish right here in October of 2020, just because of that little sell-off, and it was basically flat. And now we have reclaimed the 200 exponential and simple. So on a monthly, the last time we saw a similar move to that, where we broke down here, confirmed into a bear market, that was, this was 2000, 98, 98. And then we actually pushed up one more time in 2000, came back down, and then that was actually the start. After that capitulation move was the start of the bull market that led to our spike top in 2008. So for the next 8 years, energy was just an absolute, it was flying high. So is it possible we reclaim this level, come back down, consolidate for a little bit, and then, end up in a situation like this where we get a short-term top, come back down, retest 200 exponential and simple, maybe come all the way back down to $60, $70 a barrel, and then we, after that, go into something like that, a basically like 6+ year bull market to all-time highs, just a ridiculous bull market. I mean, if you ask me what I think is going to happen with energy over the next 6 years, I would literally point to this part of the chart and say, probably something like that. So that's what I'm looking for. That's what I'm anticipating, expecting. I will gladly admit that I'm wrong if we lose some of these key levels. But as far as I'm concerned, on the daily, looking at the chart, we're bullish. On the monthly, looking at the chart, we're bullish. The only thing is, on the daily, we may get a temporary top as of now. Now, could that temporary top be 6 months and an aggressive pullback of, another 20, 30, 40%? And it looks like oil's topped out, and all of a sudden oil's a dog again, and everybody's trapped upside down in this trade, and everybody hates energy, and it's terrible, and the green initiative, and all this stuff comes back. And the next thing you know, we're just going parabolic again, and everybody's sitting on the sidelines. I mean, that seems like a pretty viable possibility to me. So now the VIX, obviously like to check out the VIX, but by request as well for one of the group members, we're going to take a deep dive. So obviously we have been going sideways in this channel for some time. Matter of fact, we're going to pull out here real quick to the monthly chart. So going back here to, 1990, we see that every time we're up in this red zone right here, that is pretty much the market bottoming. And every time we're down here in the green zone, that is a lack of volatility and complacency, and is typically a market top. So we see obviously a market top here in the end of like 2017, 2018. We see something similar here in like 2006, 2007. And then we see it here again in like 94, and then again a retest in like 95. Now this doesn't have to be the actual top or the actual bottom of the market, but it's the top or bottom of volatility. So we know if the market's extremely volatile, it's because there's people buying and selling because there's indecision. People don't know, is the market going to go up? We're not, are we at the end of the trend? Are we going to run again? Is this a buying opportunity? Is this a selling opportunity? So people are trying to figure it out, and that's where the volatility comes from. When we're extremely bullish and everybody's bullish, we just go up. So there's no sellers, therefore there's no volatility because everybody's just buying. When we're extremely bearish and everybody's bearish, we just go down because there's nobody buying because everybody's bearish because it's like, oh, this market's terrible. It's going to zero. Like, get out. Nobody's buying. No one's buying the dips. No one's ambitious. No one's excited for it. So we know when we get up in this red zone is when we're looking for a big spike top and, a potential buying opportunity. Now, you don't want to get caught because you say, oh, here's a big spike top. And then we get the highest print ever. Or right here, oh, it's a big spike top, and it looks like these last couple, and then we get the highest print ever. But we know that's the Rona dump. That's March 2020. And where are we at now? And this is the complacency. We know what that is. That's June 2021. What was happening in June 2021? Down here, this was the market topping. This was a macro, swing high on the market, all-time highs. And, we were pointing out literally on shorter time frames, okay, this looks like we're bottoming here. We're getting bullish divergence. We're getting a double bottom. We're getting signals, hard buy signal coming out of the bearish control zone. This was all telling us, okay, look, the market is topping. We're topping out. And that's exactly what happens. Same thing we get back here. Hard sell signal, market tops out. Buy signal coming out of the bearish control zone, market's topping out at these areas. So that's what we're paying attention for. We're not looking as much for it to put in a low every time in the same area or a high every time in this area, same area, but we know that this is an oscillator. So it essentially, in the middle here at 20, that's our zero line. That's our neutral line. So when we're there, we're neutral. We're not overly bullish. We're not overly bearish. When we're above that line, there's extra volatility in the markets. Typically means we're selling off. When we're below that line, there's lack of volatility in the markets. Typically means everyone's on the same side of the trade. Everyone's bullish. So once we broke out of this internal channel that we have right here, this descending channel, that told us, okay, something's going on here. So what were we looking for? What are we always looking for on a breakout of a descending channel? We're looking for a breakout, a retest of what was resistance. It was resistance, 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 resistance. We break out, we come back down, we retest it as support. And that's what we're doing right now. If this holds as support, we then get our measured move. And that's what this green arrow is. It's just a move from the bottom of the channel to the top of the channel. It's our measured move. It's a very, simple, easy, effective, but not the most efficient way of calculating, where the move will take us to if we confirm, if this holds. And then we get, basically, we call it the, break, retest, and continuation, or, pull back into support, and then we build support, whatever you want to call it. That's basically what's happening. We had resistance, and now we're flipping it to support. And then if that holds, we continue higher. And then if we break out of that yellow channel, this is our blue move right here. And then matter of fact, let me change this one to green so I'm not confusing anyone. So then this is just the same thing of the white channel. So we now have an ascending channel. So we're basically operating with three channels in mind. Our sideways channel, that's our macro. We have our descending channel in yellow, which is our, slightly less macro, but still obviously on a monthly, we've been operating in since April 2020. And then here we have our ascending channel here in white. And now let's flip over to the shorter time frames and take a look. So once again, what were we looking for when we bottomed out right here? We were paying attention to basically, were we going to print some kind of divergence down here? Were we going to find support? So we had a key level back here in green that we had highlighted ahead of time. And then each time we were putting in higher highs. So then when we started to peak out right here and we sold off after we topped at the top of the yellow channel, we were looking for this to come back down and find support around that level. And when it did, we came down and then we actually put in a macro set of bullish divergence because here we went lower. Here we went back down to the support here, but we went lower on the indicator oscillators. So it took more energy. We see how low this point is right here. And then when we scroll back, we see there's nothing even close to that the whole way back. And then when we look right here as well, we see how low that is. And we don't see another low like that until all the way back here. And that was way higher up. So we're looking at this peak right here to the downside. Look how little that energy it took to get to that level. And then here it took us a ton of energy to get back to that level. So we see bullish divergence on the macro points at that support line. And then again, here we see micro bullish divergence too between these two peaks. Now it's only one little red histogram. I usually prefer two, but we can see a clear little hump back down, an attempt to push down lower. So here we have a low, then we have a higher low, and we have the low, and then we have that same low again. So that was the third time. The first time we, print that, hold it. The second time we print it, we print bullish divergence on the macro. The third time we print bullish divergence on the micro, again at that same support level, and that told us the VIX has bottomed. So then what were we paying attention to? A retest of the heart line on the micro channel and 200 exponential and simple. Now granted, I don't like the moving averages nearly as much on this chart because it really is oscillating. And when you have an oscillating chart or indicator or something like that, using a moving average is much less useful because typically moving averages help you to determine trend. Now the 8 and 21 still help us with trend, but the 200 is much less useful because it basically, for the most part, you're not going to see the same level of usefulness. Now it still works okay on the daily, but on longer time frames, it's basically useless. So at that point in time, we get a nice push to the upside. We end up breaking out of that channel. After we break through, we basically gapped up out of that heart line of the macro channel, out of the heart line of the descending channel. And then we started to look for basically confluence between where we top right here and that previous last top, and then where we bottom right here. And then when we come back down, we have a bottom now. So now we have 2 points on the top, give or take a little bit. We have 2 points on the bottom, give or take a little bit. Not perfect. It's not perfectly drawn. It can always be shifted a little bit or interpreted a little bit differently. It might look a little different if we look at the S&P, volatility index versus the NASDAQ volatility index, et cetera, et cetera. So there's always going to be a little difference. We don't need it to be perfect. What we're looking to determine is what are the market makers? What are the, macro influencers, the whales, the people that matter? What are they seeing? What are they doing? So when this came down here again on that third peak, we basically peaked all the way here. We broke out and confirmed, but we didn't hold this level in yellow. So that gave us a, okay, it could go either way, but we held the heart line. We hit our target to the downside, which was this blue box, which was a 200 exponential and simple, and then basically just another higher low. So now we have a clear trend to the upside. And then when we break through this yellow descending trend line, now we have broken out of our descending channel that we were inside of for literally years since the Rona dump. So we had no volatility while the market just melted up. We had less and less and less and less volatility. We double bottom with bullish divergence, and then we break out, come back down, put in a higher low, start trending to the upside on volatility, telling us, whoa, hang on, something's changing here. The trend is changing. It was a macro melt up, and now it's not. People are not confident. Volatility is starting to pick up. That tells us, oh, it's on. So then we break out here, we come back down, we put in a third higher low, and then we actually form this blue trend line right here that begins. And then we come up here once again, and now we have a fourth touch on the top of the channel. And then what are we looking for when we top out up here? We're basically looking for a push up and then put in a lower high and then see that roll over. And again, it lines up with what do we see right here? We see a peak, we see a lower peak, okay? And then we see a peak right here, and we see a higher peak. So we have a peak right here, and then we have a lower peak through here. That's bullish divergence between these 2 points. I'm sorry, that's bearish divergence between these 2 points. And then between this peak right here and the peak right next to it, that's macro, between these 2 points, 2 clear points. And then the micro is an internal bearish divergence between these two, because here we have a peak and then a higher peak. Here we have a peak and then a lower peak. So we have bearish divergence between these points. We have bearish divergence between these points. And then again, we see the sell-off. And what are we looking for with the sell-off? And what are we talking about in advance the whole time? We're looking for the retest of the yellow channel breakout. We're looking for the retest of the blue ascending support line, which is much less important. But, that gave us basically this green box right here. And remember, when we drew that in, that was a while ago when it was still up here looking all juicy and volatility was looking great. And then what happened? Well, we're at it now. We closed exactly at it on Friday. So, does that have to be the bottom? Is that it? Is that the top in the markets? And now all of a sudden volatility is going to pick back up and we're going to sell back off? Well, let's think about what happened. Okay, so we recently got, a bullish catalyst, which was the Fed came out and raised rates 25 basis points, which was quote unquote already priced in. So if it was already priced in, why did we get bullish? Well, the fear went away because people were afraid we were going to raise rates more. Sure, that's legitimate. So now nobody's afraid anymore. Or is that just something that was looming over the market's head and now that's gone, but nothing has really changed? Has anything changed in the markets? No. Has anything changed in the economy? No, not for the better. Did the war stop? Nope. Did, interest rates not going to get raised anymore? Nope. Is the Federal Reserve going to start, decreasing the balance sheet? Well, yep, they are. Is the Federal Reserve going to continue buying mortgage-backed securities and treasuries? Nope, they're done with that. So those are all bearish catalysts as far as I'm concerned. So, was this just a reflex rally based on, basically futures, short covering, etc.? I mean, bots and algos jump in as people cover. It seems reasonable to me. So I don't see a macro force that would all of a sudden say, okay, we're done selling off now. Volatility is through. And now this trend that we have been establishing to the upside, this bullish trend inside of the VIX, volatility, which typically corresponds with lower prices in the stock market, is done. It's over. It's all finished now. I don't see that. I see the opposite. I see us pulling back to a key level, and now we're going to see, does this hold? Now, if this breaks down right here, we still have the heart line. We still have the bottom of the channel. I would still be confident. I'd still be okay with it. If it holds right here, though, and we start to get a bounce and a move back to the upside, it will look extremely bullish on volatility, telling me it's time to be, very bearish on the stock market and, risk on assets, which I'm inclined to say that I already am. But again, it's up to the market to tell us what's happening. We're just here to interpret it. So that's what I'm seeing. So if we bounce right here and start to move back up, that's going to take us probably to a new high. But we know that we have a short-term ascending support. We know we have, we're well above the 200 exponential and simple on the daily. We know that we have broken out of a descending, channel that we've been inside of for the last couple of years since the spike top. And we know more likely than not, all those things are pointing us to the upside on volatility, which is pointing us to the downside on the markets. So we're at our box. Last time we hit the box, we reversed right away. Now, granted, this was a pretty big one, but here we are exactly at our box where a bunch of lines correspond. Could we come down slightly lower to the 200 exponential? Would it still be okay? Sure. I mean, we could even have a wick that comes all the way down here to like 20. And it's like, oh, we're neutral again. Volatility's gone. Everything's safe. We're great. We're juicy. We're gravy. And then, next thing you know, volatility shoots back up to the upside, leaves behind a wick, gives us a bottoming candle. And then that's it. And, volatility's back on. So what's up, honkiness? Good to see you, brother. All right, so next we'll look at the Dow Jones. So we'll see how this corresponds and what we had anticipated and how, and obviously it's going to look like, oh, if we know what was going to happen with the VIX, and then we look at the Dow Jones and we're like, oh, look, we were right here too. Well, of course, it looks like we're right because they're just inverse the same chart of each other. Now, obviously, the Dow Jones is trending to the upside as where the VIX is basically an oscillating, volatility measure. But what was our anticipation? What was our prediction? What was our target on the Dow Jones? It was obviously a retest of 200 exponential or 200 exponential and 200 simple. So that's basically, we're right smack in between the two of them now. We had confirmed into a bear market. We're retesting back up. We have technically flipped them back to the upside. If we start closing back above 35,000, we can't help but be bullish. Now, we could be a little skeptical. We could take our time being bullish. We don't have to just immediately be super bullish. But, we have to be bullish because that's what the market's telling us. And then obviously, we see where was our target. Our target was the area between the 200 exponential, the 200 simple, and the horizontal green support. So no, we did not talk to Miss Cleo. No, she did not read our fortune. We didn't shake Jim Cramer's magical 8-ball. We didn't make a pact with the devil and use a Ouija board to get Dow Jones targets to the upside. No, none of those things are true. We just used simple technical analysis. Extremely, extremely simple technical analysis. We used horizontal, support and resistance. We used, trend lines, 200 exponential and simple, and the, moving averages along with the descending channel. That's it. Simple. So here we are. We have one touch, two touch, and we're at the third potential touch right now. And we have 1, 2, 3 on the bottom. You could arguably have drawn this different ways. And again, sometimes we'll revisit the way we've drawn something once price continues. And we'll say, okay, we were clearly off slightly on how this was drawn. Maybe it should have been, down here based on these wicks. And, the heart line should be right here. Does that change the bigger picture? Not really. Maybe it'll just look more accurate. If we get another wick down here to the bottom, it's like, all right, we're probably looking at this wrong. Or here we just have 2 touches. I mean, there's a million ways you could do it. I like it this way just because it looks like we were bouncing the heart line and getting rejected there. And then it looks like we came back down. Exactly. It looks like we were breaking down from a key level, got bought back up. Breaking down from a key level, got bought back up. So we held the bottom of the channel twice. I mean, we didn't. And then we came back down to it a third time and we stopped right at it and reversed. So that's what I'm looking at. That's why I have it drawn this way. You can draw it however you want. Doesn't matter as long as it's working for you. So once we bottom right there and we get the bounce back to the top, now it looks like we're just hitting that trend line once again. And what do we have now? So now we have a ton of trend lines and moving averages. We have a 200 exponential. We have the 200 simple acting as resistance right here. So that's going to be a tough area to get through because this is the move that we always buy on the way up and we always sell after we break down from it. This is the reversion of the mean play. This is the last good move, as I like to refer to it, the last hoorah of the bull market. Because what happens? We buy the 200s every time we come down to them. We start to get skeptical of buying the 200s when the 200 simple crosses above the 200 exponential because we're losing momentum. We almost always, after that happens, put in one more new all-time high. So we get bought up. We break down from it. That starts to look bearish. We come back up. We put in a lower high. We break down again. We put in now a lower low. We're trending to the downside. We push up again. This is our reversion to the mean play. Okay, you buy right here or you sell right here. So instead of buying the dip every time, we're now bearish. So now we're selling the rip every time. That's my strategy. Obviously, it's up to you to determine what your strategy is. When are we wrong? Well, we're wrong if we get back above 200 exponential and simple, consolidate, and start to move back to the upside. At which point in time, there's very little risk to the downside. If all of a sudden it reverses again and then we break back down and then they flip bearish again, we just sometimes you get a little chopped up. Maybe it costs you a couple %, but at least you're avoiding massive losses because that's our job. The job is if you participate in markets long enough, sure, maybe if you pick this asset, you make this %. If you pick this asset, you make this %. And you would have done better if you picked this first asset over the second one. But the truth is, you invest long enough or trade long enough in bullish markets and you're going to make money. You're going to succeed. The real goal is to not get chopped up or not have a massive loss. So the most important thing is just protect your principal, protect your capital. After that, you're going to make gains. You're going to make gains. I mean, in a trending market, all you have to do is just not get beat down on the big losses. So a lot of people choose to just not sell. So they're like, well, if it's always trending to the upside on a long enough time frame, I just don't ever sell and it always goes up. So I win. Trading is just more efficiently investing because you're avoiding those losses and then getting back in time for the gains. So if we get back in right here and we basically got out right here, sure. Maybe that costs us, let's say right here after that sell off, after we confirm into a bear market, and then let's say we get back up here. Let's say it takes a little bit to get back in. Sure, maybe we lose 3% and not lose 3%. We buy, instead of getting $100 in stock back for $100, we get $97 back. Well, sure, that sucks. Okay, we lost 3%. But what we're looking to do is just avoid these. This is our main goal, is just to avoid these. Because this is where it flips bullish, breakdown, retest, and then continuation to the downside. This is the bear market hoorah, the last hoorah of the bull market. And, would you risk a 3% buyback at a higher price to avoid a 31% capitulation? Definitely, 100%. I would pay 3% all day. That's like literally saying, okay, hey, there's a good chance you're going to total out your car today when you go driving and your car's worth $100. Will you pay $3 for insurance? And if you total your car, we'll replace it for free. But hey, you know what? If you don't total your car, you're out that $3. Are you going to be mad you paid $3 and then you didn't total your car? Or are you going to be happy that you paid $3 to protect yourself and then didn't total your car? It's all about how you look at it. I would rather buy. Some people, the answer is no. I would hate that I wasted $3 and didn't total my car. And that's up to you. That's complete trading psychology. And that's completely fine. Some people will sell an asset or a stock or whatever and they will refuse to buy back in because they don't want to buy back in higher. So they'll say, well, I'll just wait for it to come back down and then I'll buy. Well, I'll just wait for it to come back down and then I buy. And the next thing you know, 10 years have gone by and they never repurchased that stock. And now they hate stocks because they couldn't just swallow their pride, and say, okay, I was wrong. We didn't go lower. I don't look at it as swallowing my pride. I look at it as paying for insurance. I paid the bill, paid the man for protection, didn't need it. It's like a market condom is all it is. We're just wearing our market condom, okay? You're not necessarily going to get the market pregnant if we break down below this line. You're not necessarily, going to get an itchy and a scratchy. You're not necessarily going to, need some penicillin if we break down from here. Maybe you like the pull and pray method. Me personally, I'll just wear protection. Better safe than sorry, okay? So I don't want to have babies with the market, especially not with all these overvalued tech stocks. I don't want to, give up 50% to the market baby mama because, I couldn't protect myself. There's your analogy for the day. So that's how I look at it. So we can easily, change our mind if we get back up here, if everything looks good again. But right now, what I see when I look at this chart, I see a top. We anticipated this move. We got the move. And then when we really zoom out on the macro, and then we'll keep moving on. I know you guys hate when I spend a ton of time on like one chart. But I mean, I look at the Dow Jones as basically the market. That's everything. It's the most important stuff. It's basically a gauge of the U.S. economy, which is, arguably the most important economy because we have the world reserve currency. So here we're on the monthly. There's a lot of different ways you can draw this red line, but just for, perspective, and then we're actually going to go down to the weekly. This is basically, a top a bunch of times, and then we come down, we find support on it, and then we break down below it, and then it acts as resistance. That's what this red line is on top right here. And then this blue line here is a bottom. That's our bottom wick right there. We slightly shoot through it right there, and then we have this other little blue one drawn in as well. Here's our hard sell coming out of the bullish control zone, sorry. Here's our hard sell coming out of the bullish control zone. Here's our hard sell coming out of the bullish control zone each time. Looks like, basically a peak. When we zoom out big time on this chart, this going back, 100 years, and we know when we look at this, we operated inside of, can you guys see that, or am I blocking it? It should be okay. Let me zoom out just a little bit more. Okay, we'll just put it right here for a second. So we see we're operating inside this channel, and then we get, basically a spike top out of the channel, a breakout, confirmation, measure, move to the upside, and that is August of 29. Okay, so that is basically, the top of the roaring 20s, and we know what came after that. So then we break down and do basically the same move below the bottom of the channel. And then at that point in time, it basically amounts to a 618 or 78.6% retracement of the move up to it. And then at that point in time, we operate inside the bottom, resistance of this channel the entire time until we finally break through the bottom in 1994. And then from 1994, we operate in the top part, which is this purple line right here. So then the yellow starts acting as support, and the purple starts acting as resistance. So now here we are, we've broken out to the upside, past that red line, which is shorter time frame, past the purple line, which is the longer time frame. And if we go back to our last macro bottom right here, and we put a fib in place, and we assume that this was, basically our potential cycle topping out, which it doesn't have to be. We could easily continue to the upside, and this is in no way the end of the cycle. Let's see if this looks important at all. Let's see if there's any important stuff going on here that maybe catches our eye. Do we see any kind of interaction whatsoever with these green lines? Or does it just look like they're randomly drawn in places that don't matter at all? I'll answer that question for you. So it looks like, and again, we can only see this really in hindsight because we didn't know where we're going to top out at. But now that we have a fib from the bottom in 2009, which was after our last capitulation move, which was obviously, the global financial crisis. So Fibonacci from the bottom of the global financial crisis to the top of our, insane bull market that we had right here. And now let's see what looks important on this chart. What key levels do we see on this chart? Well, let's take a look. So we push up right here, and where do we go to? Well, that's our 618 in green. And that is basically a top in 2011, we come back down, we break through it, and then look at access support. So that looks like a pretty important level, the 618. And then we come up here, and it takes a few months to grind through it. And, that is in 2013. And then we break through it, and it access support. So that looks pretty important. And then we actually push up here and almost make it to the 382, but we get rejected, and then we just stop in the middle of nowhere land, right? We just double bounce in the middle of nowhere. Or actually, no, wait, that's the 0.5 exactly. The wick exactly to the 0.5. So, man, this thing's starting to look important. And then, look, we top out here again, finally break through it, and then we shoot to the upside, go parabolic. And then what do? We break through to 236. Well, nope, there's nothing going on here. And then support, 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 break down below it, get back above it, support, break down below it again, get back up to it, close that macro bullish candle at the 236 exactly after the capitulation dump when the, Fed and Treasury and the Rona dump. And then what happens after that? We go absolutely parabolic, and then we put it on our top right here. So, I mean, I would say my opinion is that we literally, looking at this chart right here, and if you were like, hey, draw some important horizontals on this chart, where would we draw them at? Well, we would probably draw one around here, maybe one around that top right there, probably one somewhere in this region right here, maybe like, right there, or arguably right there. Probably draw one somewhere around here, the top right here and the bottom right there. Maybe draw one somewhere around this area in here, maybe this area in here, and then obviously a top. And then, obviously that's where all these fibs line up. So is that a coincidence? I don't think it's a coincidence. I mean, it is what it is. Obviously, it's up to everybody to determine that. Maybe it is just the craziest coincidence ever. But I would say there's a good possibility that the market makers, that the whales, that the governments or 0.1% or whoever it is, the bots, the algos, the aliens, the king of Atlantis and the sea people that are getting ready to rise, the, rat people in the center of the earth, like whatever, the lizard people, whoever it is that controls these markets, conspiracy theory or not, whatever you want to say, I would say there's a good possibility that this Fibonacci is important for one reason or another. So, and I have proof because when we look at this chart, it lines up pretty damn well. So that being said, if, for instance, we were going to have a 236 retracement on the Dow Jones, that would take us to, that's the first, relevant retracement. That is $24,000. That is $10,000 drop from the top and roughly, 30%? 33%? And realistically, typically what happens is you hit the 236, you get a bounce, and then you actually put in a lower high, and then you go lower. So realistically, our target is a 382 for the macro. Well, it just so happens the 382 lines up with the heart line, which is that yellow line right here previously. And then now look, if we extend this out, which is, the bottom of that going on right there, that happens to just also happens to line up exactly at the 382, exactly at the heart line, exactly in the exact same spot. So is that just a total coincidence? Can we look back at this chart and let's see, assuming I haven't retired by the time we get to October of 2024, and I'm still doing videos on the internet, which I anticipate I will be doing, I would say that we can come back and we can look at that area and say, well, that's weird. That's so strange that we actually came down to that exact spot. And, that's where we're hanging out now. Now, what's it going to look like on the way down? Are we going to get an ABC? Are we going to get a 5-wave? Let's just use the 5-wave just to kind of see. So it would assume we get a move back down to 236, maybe along this ascending move right here, something like that. Then we come back up and we top at the horizontal resistance from the initial push up right before the Rona. And then we come down a little lower, break down from a key level. And then we come back up here, retest resistance as support or support as resistance. And then we finally get the last move to the downside. So does it look, something like this? I mean, I could see that, right? I mean, it looks crazy right now because you're like, yeah, you're calling for $18,000 Dow Jones. That's a 50% drop. That's only happened, how many times on this whole chart? Sure. So probably doesn't happen. But, I mean, will we be surprised if it does? I don't think so. So that's what I'm paying attention to. That's what I'm looking at. And then when we switch over to the weekly, is when it really starts to just, I mean, look, again, I'm not trying to be overly bearish. We could easily go to new higher prices before any of that takes place, but would it be unrealistic to think, you know, this is our blue descending support line. This is our shorter term one, obviously right here that we drew in, that I was just showing you. And then here we have our purple and our red of what amounts to, you know, a megaphone pattern. And the thing about the megaphone is it's basically just a large consolidation. So the same way we have like a wedge normally, where it starts off big and then it gets tighter and tighter and tighter, and then it builds up all that power. Imagine taking a bouncing ball and you have a wedge like shape, and you bounce it as hard as you can in the fattest part of the wedge, and it bounces from the bottom to the top to the bottom to the top to the bottom to the top, and it starts to pick up velocity, and it just, and then it finally comes out the end of it and it shoots in one direction or the other, either up or down. Well, it's sort of like that with this wedge, but it's the opposite. It starts off bouncing super fast, up and down, up and down, up and down, and then it finally, you know, as it widens out, the top, the bottom, the top, the bottom. So it takes more and more time, but then eventually when it breaks in one direction or the other, you know, it just, think of it like a, you know, kind of like, oh, what was that game? Super Breakout, where the ball's like, you know, it's bouncing really quick between a bunch of bricks, bouncing really quick, and then it's like slowly chewing through the bricks, and then eventually it breaks in one direction or the other, and then it just like shoots off into like nowhere land forever. Just nice and slowly just gain. So that's what probably happens eventually to the upside. But do we go down first? That's what we have to look out for. So the way I look at it right now is we're in a position where the market is bearish and we're 3% away from being bullish if we reclaim those key levels. But our initial target to downside is 33% down. So that's a 10 to 1, you know, risk reward ratio to protect ourselves. And if we're right about the macro move and we go all the way down here to the 382, that's 48%. So we're paying the market 3% right now to protect us from 48%. So if you're, you know, thinking, hey, I'm going to go drive recklessly in my car, or I'm going to go, you know, run around with all my money recklessly, and I was like, hey, will you pay 3% to protect yourself from losing 33% of your money or 50% of your money as insurance? And you say, nah, I ain't wasting that. I'd rather spend it on, you know, whatever. Sure, that's fine. That's completely fine. But for me, you know, I work hard for my money, so I plan on keeping it. And that's how I'm looking at the Dow Jones right now. So we'll see what happens. Obviously, in the long run, we have some targets along the way. 200 exponential and simple lined up right here. That's our initial target. And then we have a macro target way down here. You know, and again, that's not until September 2024. So we got plenty of time before we get there. But that's what I'm paying attention to. Does it have to happen? Nope. Would I be surprised if it doesn't happen like that at all and I'm completely wrong? Nope. But if it does start to happen and we're like, oh man, that's crazy, we actually planned for this. So looks like the market's doing what we said. Much rather be prepared for it than not. So the S&P, same thing, bounce back up to 200 exponential and simple off that bullish divergence we were talking about. You know, basically just right at the 200 simple now. We do have 3 big green candles in a row. That is like 3 white soldiers, or if you want to be politically correct, 3 green soldiers. Which is a bullish pattern, typically leads to continuation to the upside. At resistance, we'll see. This looks slightly better than the Dow Jones does. If we look at the IXIC, the old NASDAQ composite, you know, we have a target slightly higher, which is 200 exponential. Obviously, in a bear market, trying to stop that bear market, the 200 simple is all the way up at 14,700. 200 exponential is right here on its way down to 14,143. Which just happens to be our target based on our previous double top right here that we broke through, and then it acted as support, came down here, broke through the support, acted as resistance, breakdown, couldn't get back to it, almost hit our measure move to the downside, and then finally some bullish divergence, and we broke up from there. So I would expect us to top out again somewhere right around that level. The old ruddy. Finding support at the 236. So we're talking about the Dow Jones breaking down to the 236, and it sounds crazy because it's like, oh no, about Dow Jones isn't going to break down to the 236. That's just crazy talk. But when we zoom out on this chart, you know, that's basically just the 236 of the macro at 24,000. Let's look at it on something that's less bullish. like the Russell. I'm going to switch out to the monthly right here. So that's our Rona bottom right here. This is our corresponding one from bottom of 2009. And again, we could see obviously some confluence along the way up. Here we see resistance at the 618, support, breaks through it, comes back down, resistance and support at this level. Bounce up here all the way to the 382, chops around it, support, breaks down, resistance, comes all the way back down to the 0.5. Then we move up to the 236, chop around that level for a while. We break down and we don't close below the 382, but we wick all the way down to 200 exponential and simple and almost to the 0.5. Then we put in our top right here. And the 236 in yellow is from the bottom of the Rona, which we already hit, telling us we have probably topped out on the micro. And then the 236 in green is the macro from our previous cycle top in the global financial crisis. And what are we looking at on the shorter term here? I'm going to switch back to our short time frame again. I'm not trying to like jump all over the place, but I want to just show you how there's like confluence between these various targets. So if we push up here and then we end up getting rejected and then we come down lower, our next target to the downside is that 382. So if we see this come back down to the 382 and then we say, okay, it's probably going to break in one direction or the other, either come back up and retest the 236 or break down lower to the 0.5 in yellow. Well, now we know that the 382 actually, right here in yellow, if we break down from there, that takes us back to the 236 of the green macro fib. And then this yellow line right here, matter of fact, let me change this to a different color so it's not confusing. The line right here is the top right before the Rona. So we have the top before the Rona, which is the decision point, and also the 382 of the Rona dump to the peak. So that let's say, just for instance, we come up here, we top out, we break down to the 382 like expected. Then we get a bounce back up to the 236, it rejects us. We come back down, chop around, we break lower. Then we hit the 0.5 of the COVID move. We break down from the previous high resistance from pre-Rona dump. And then we come down and confirm the 236 of the macro, which just happens to line up perfectly with the 0.5 of the Rona. I mean, does that sound crazy? I don't think so. I really don't think so. I mean, that sounds like that's probably what's going to happen. Now, again, could we move back up here? Reclaim $2,233, and it's like, dude, you're crazy. That didn't happen. You're 100% right. Didn't happen. But if it would, we were ready for it. And that's the most important thing. So XLE. So now we have energy. What's going on, Sohail? Good to see you, brother. Honkiness. I think I already said what's up to you. So XLE, if not, double what's up. So XLE, energy, obviously we looked at oil. We talked about the spike. We're seeing this obviously at some extremely high levels. We have saved the 821 cross to the downside. We don't have any longer term divergence really going on, as we did put in a higher high and higher low. We do have a hard sell. We left the bullish control zone. We're pretty far away from 200 exponential and simple. At this point in time, a retest of this key level, and don't mind how ugly this looks right now. We basically hit our target to the upside. Realistically, almost hit both of them. But this key level right here, the previous resistance, would be the 618 of the macro, which sort of lines up at 200 exponential and simple. So we're looking for somewhere around like the high 50s, probably closer to low 60s, as I assume that will get bought up pretty aggressively for a move back down. Maybe it doesn't get there, but that's what I'm looking out for. Transportation. So we have this descending channel. We had a little poke out of the channel right here, so maybe it's not drawn perfectly. I like how the heart line kind of looks along the way. Broke back above 200 exponential and simple. 3 big green candles in a row. Looks like someone is, I refer to this as marching the price up. Looks like someone is marching the price up. Looks like someone is intentionally just moving the price up. There's no wick to the downside. There's no wick to the upside. The price literally opens, moves straight to the upside, and closes at the high. Then it opens lower, moves straight to the upside, and then closes at the high. Never even pushes down. Then it opens lower once again, moves straight to the upside, and never goes down again. Does that look like a natural, organic move? Or does that look like, a drill sergeant marching along, some troops to a cadence. That, to me, that is not natural. Do we see that anywhere else? Is there any other instances of natural movements where there's just candles opening and then closing? You know, in a nice bull trend, do we see that? In a bear trend, do we see that? Do we see even a couple of those? Does that look natural to you? I mean, I'm not saying it's manipulation, but it sure looks like somebody, you know, is moving the price in a direction intentionally, you know, for whatever reason. I can't imagine why. So that their futures contracts expire nicely, to break out of a, you know, specific area to move price to the upside. You know, I mean, I don't know. I don't know what somebody's vested interest would be, but this doesn't look natural to me. And we'll see it happen a lot of times. But I call it marching the price. So you'll hear me refer to that when they're marching the price in one direction or the other. But the breakout, if we do get the measure move, should take us back to that previous high right here at 95.70. So that's what we're looking for if we do see continuation on transportation. If we don't, and you guys know my macro on transportation, I don't have to tell you about that. You know, we typically top out and bottom out in these cyclical patterns. Not every one is a macro top or a macro bottom, but it's typically around the same time of year and around like that same point. And, you know, this was potentially a top, a lower high, and then we would break back down and then potentially be bottoming somewhere around like December 2022. You know, at essentially that previous level from 2018 all-time high that acted as like basically a double top before the Rona dump. So we'll have to wait and see. Obviously had this drawn in place a while ago. We don't know how that's going to play out. Maybe it doesn't play out at all. But that's what I'm looking at. And we know each time that we are in this ascending channel and then we break down, we end up putting in, you know, a pretty heavy retracement over time. Ascending channel, breakdown, pretty heavy retracement over time. Ascending channel, breakdown, probably going to put in a pretty heavy retracement over time. Or we'll just do something completely different. You know, and keep in mind, these tops were corresponding to like 2018. And then this one was corresponding to 2014. And then we don't actually have more history on this chart specifically, but we know what other times we were topping out on transportation. And, you know, all these macro factors that we discussed, the four horsemen, 2000, 2008, 2014, 2018, all these key times in history. So XLF, reclaiming 200 exponential and simple, looking pretty decent at this point in time. Still don't love this chart or this space in general, but overall looks decent. As reclaim the 200 exponential and simple, you know, if you wanted to be bullish on this again, I'd say, you know, you'd be justified in doing so. One thing I'm looking at and paying close attention to is the confluence between these 2 points. We have a clear top, you know, or potential top at this blue support bottom right, or yeah, what was support potential act as resistance. And then we have a clear top on the channel that we've been operating inside of. This gets a little sketchy right here. So, you know, maybe this gets invalidated. I don't know. But that looks like a little confluence between those points and a likely target on financial, which is $40. I mean, we're at 39 right now. So it's $1 up to the upside, but, you know, a couple percent, 2.5%. So we'll have to see how that plays out, if that plays out, or if financials just are ripping and rolling and hitting new all-time highs. Give me 1 second. All right. And then communication, bottomed at the 382. This is the Rona dump right here. So moved all the way to the top, broke down from a key level, lost 200 exponential and simple, entered into a bear market. We talked about the, you know, I talk about these parabolic trend lines all the time. We have them on Ethereum. And just to show you how important these are, and that I'm not the only person that does this, here we have 1, 2, 3, 4, and then a breakdown. And then we break to the upside and we come exactly back to the parabolic trend line. And then here we start a fresh one. 1, 2, 3, 4. And then we break down, capitulate, bounce a couple times. And now here we are stopping right at the parabolic trend line again. So maybe we break through it. If we do, we probably come back and retest the prior parabolic trend line in orange here, which would give us a move back to like roughly 72. If we get rejected again, we probably just go lower and see this like, the bloody waterfall in full effect. But nice little move off of some short-term bullish divergence there, off of a key fib level. Obviously perfectly hit the 382 and our target to the upside. I'm not playing a lot of these counter trend moves. You could if you were like really interested in it, but to tell you the truth, I'm not really that interested in it because there's so much. In my opinion, there's a lot of headwinds in this market right now and not very many tailwinds. It's very hard to be bullish in these markets right now for anything more than like a few days and just a quick little bounce. And I'm not looking to get trapped in positions for what can amount to like a multi-year bear market or take unnecessarily losses after just like absolutely crushing it for the last couple of years. In my opinion, now is more of a time to just be a little more cautious, a little more conservative. And, think about over the last year, think about how not many things put in new all-time highs. Not many things are much higher than they were a year ago. Most things are substantially lower. So sometimes the best thing to do is just pick and choose, the best opportunities when everything looks perfect and lines up and, it's easy and it's simple and you just see money laying there and you're like, oh, I think I'll just take that. Versus trying to like chase after something that you're going to have to work a little harder for. And it's not being lazy. It's just looking for easy opportunities. Because that's what this is all about. And that's why a lot of people only like stocks or only like crypto or won't trade commodities or, whatever it is. Don't like certain whatever. They're like, oh, I don't want anything to do with growth or I don't want anything to do with value. I refuse to trade energy. I refuse to this, that, and the other. The best thing to do is I hate to quote Jim Cramer, but I mean, there's always a bull market somewhere. We just got to find it. Just look for the easy move and just pick that up. It's been energy. That was easy. Before that, it was crypto and basically anything. That was easy. So what's the next easy one going to be? That's what we're looking for. That's why we're putting in the work, figuring out exactly where the next easy one's going to be. So XLU, just holding support at these key levels. It looks pretty toppy here, but I'm not convinced we don't go higher. Does look pretty toppy, but it looks like this actually wants to bounce and go back up. Doesn't have to. It could easily cross right here. A couple days away from knowing, though, whether or not we need to protect ourselves on this one. But I mean, if it does go lower, I don't think it goes much lower. I mean, this is that safety play, honestly. If you're in utilities, you're in it for just safety to the upside or downside. You might not make much of the upside, but you're not going to lose nearly as much of the downside. XLRE, reclaiming 200 exponential and simple. Again, do we see more or less headwinds for real estate market? I mean, there's a lot of headwinds for the real estate market, but it also lags a couple years. So if you get trapped in real estate, it's only because you didn't see the signs coming from like the actual economy and the stock market, because this will take forever to have the same downside, if it does. VWO, Vanguard, emerging markets. So we know obviously China has pulled this back up pretty aggressively, and we're just consolidating in that range. I think we chop around here for a bit, and then whichever direction we go in, we probably see continuation. So we either probably see continuation up to 50, which is, almost 10% to the upside, or we probably see continuation back down to the lows, which is like 41. So we're right smack dab in the middle of whatever's going to be the next move is probably 10%. Hard buy signal, a bunch of green histograms. It's trying to cross back to the upside, but keep in mind, it's in a very clear bear market. So if we do push back up to the upside, that's going to look like the reversion to the mean bear market play, followed by continuation to the downside. DAX, Germany, again, reclaiming key levels, pushing back up, holding support the last few days. Looks like it wants to cross 821 back to the upside. It really should move back up to like 29.72. And then we'll see what happens there. It's probably going to be resistance and then revisit the lows. But, I mean, we're really just looking for this to probably just looking for this to chop around. Even if it came all the way back up to 30.93. It wouldn't look terrible. That would basically just be a reversion to the mean, 200 exponential and simple, heart line. And then again, we want to see it come back down here, hold support, and then maybe we could get bullish on a higher low support. We want to see some kind of a swing and then a hold at a higher low, possibly some bullish divergence, and then it's like, okay, this is starting to look good now. But it's, I mean, the last place I would want to be invested right now is Germany, because they are 100%, you know, at the whim of Russia right now. So CN50. So, you know, obviously we can get a pretty macro outlook on China, but, you know, we're basically at a key support / resistance level. Even a push all the way back up to like 14,572 doesn't change much. Got to really just see how this plays out, but we're definitely in like a, oh, I thought I had it on this chart. I might have it on my other one. If we look at this as some kind of, you know, depending how we want to draw this, I think I have it like this. It's not beautiful, but it has a bunch of interaction with the heart line here, 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 here. And then just one touch on the bottom, and then one touch right here on the bottom, and then one touch on the top, and then, you know, one kind of close at the top. So it's not beautiful. It's kind of subjective. Maybe it should be a little bit closer to like that. I don't think that changes much. Maybe it makes it a little better, but that's what I'm looking at. Descending channel in a bear market below key levels of horizontal support, which, you know, we would expect to act as resistance. And, you know, basically a potential pushback up to what would amount to, you know, essentially probably a rejection and continuation to the downside. UK, pretty aggressive move back to the upside. Now we want to see, does this round out and put in another lower high, or does it break out to new highs? Honestly, I was not expecting UK to have this aggressive a move back up. It made it all the way back down to the 382. I would expect it to get rejected around this level and then break back down from here. It doesn't have to. Does not have to, but I mean, that's what I would expect. But again, I didn't really expect it to be this aggressive to begin with. So, I mean, as long as it's holding this trend line, it actually doesn't look that bad. Holding through there. So reclaiming that is definitely a big deal. Now, obviously, the 200 exponential and simple are basically doing the same thing. So as long as it holds above 73.09, you know, I'll have to remove my bias on this because it actually looks okay technically. But I do expect this is going to put in a lower high. We'll see too. Does it put in some kind of divergence or not? Does it get rejected at the slope line right here with all these green histograms, or did it just keep ripping? Could go either way, honestly. Could go either way. I didn't expect it to come back up this high, though. I'm not going to lie. That was a nice move. EWZ, Brazil, ETF. You know, we're just at the central portion, reclaiming 200 exponential and simple. Target to the upside is 41.77. Target to the downside is 26.33. You know, I would have to give Brazil a slight bullish bias just because of their commodity exports. And I just don't see things like commodities like food, coffee, like necessities. I just don't see them going down over the next couple of years. And Brazil has so many exports that are basically like, you know, consumer like goods that they can't do without. I just don't see. I mean, I could see we could have a temporary pullback, but I don't see Brazil just going down lower and then going much lower. I think more likely than not, what's going to happen here is we're just going to basically be putting in a series of higher lows. So if we broke down from, depending how you wanted to draw it, you know, if we broke down from basically these, you know, you could arguably have this down here. You could have it right there. You could look at it on a longer time frame. Whenever it breaks down, if it breaks down and provides an opportunity for us, I'm going to look at that as a buying opportunity, because I'm going to give Brazil a bias based on fundamentals, you know, that it's going to go to the upside. Now, technically on the chart, does it look bullish? No, it looks like it's about to have at least a temporary pullback. And then essentially when we pull out to the monthly, you know, that's basically it bouncing. I think we could probably move it like that, and it looks a little better on the monthly based on the closes. And then we could put something like this too for like, you know, a parabolic trend line on the monthly. So I would be looking at something like that as like key levels. So as long as we basically, I mean, we got rejected at the 200 exponential the first time. We put in a higher low. So maybe we come all the way back up here to the 200 simple and get rejected at 47. Maybe we, get rejected right here, come back down, put in a higher low, and then we get the move to the upside. But we're right smack in the middle, so there's not a great entry right now where we're at. So we have to either be patient and get it down here when it pulls back, and then target, this, and then obviously like higher. The second trade setup would basically be the same move to the downside, but then targeting the 200x simple rather. So that's a 38% move to the upside with a 6% stop loss. This is a 55% move to the upside with a 6% stop loss. But if we were to try to take that same trade from where we're at right now, we really can't like start to invalidate until we either take out that low or break down below that key support, and the stop loss is exponentially more. I mean, we're talking about like a 19% stop loss. And then if we're targeting the 0.5 or even the 200 exponential, that's 10% move to the upside. That's 19% move to the upside. That's barely 1-to-1. So that's like basically a coin flip right there. And then best case scenario, we end up with a 2-to-1. So I'd rather be patient on this one, wait for the market to come to us. If it starts to run away, then maybe we can get it on a retest of the 382. But after having broken down from the 382, I would rather see it come back down and hold a higher high, or a higher low rather, and then get an opportunity on it. And we didn't really have a support line ascending. We only had the 236 prior to that, and it didn't really give you much time to enter in. I mean, you could have come in after that candle right there, and that would have been okay and probably giving you a much better risk reward trade. But from where we're at right now, hindsight's always 20/20. That looks like the best play. So, and then looking at it on the weekly, we'll see it's already, at the 200 exponential and simple, and this is our initial test back up after coming back down to the fib. So we retested it once, got rejected, retested again, broke through it, didn't hold it as support, came down, put in a higher low, coming back up to it again, we would expect a rejection, roll over, and then we can maybe bite when it comes back down here. If it just shoots through here and moves to the upside, we got to wait for it to come back down, and then we can just take a trade off the same spot, but on basically support holding, and then expect continuation of new highs. So essentially what I'm looking at is, if we take a trade right now and we're right, we get a nice little upside move. If we're wrong, we get stopped out, and that's it. If we wait for it to move and we skip the next move to the upside and it's bullish, we get it on the way back down, and there's much less risk. And same reward, because we're at that same level already. If it gets rejected right here and comes down to our target, there's much less risk. We get much more upside potential and higher likelihood of success. So in my opinion, this one we got to just hang tight on. So Brazil, hang tight for me. And then the 210 spread, I've been talking about this. Obviously, this is, another indication of recession, obviously. And we see the 2 has gone absolutely parabolic, and it's at 1.942%. And we see the 10 is at 2.155%. So we know the 210 spread is roughly, 0.058. So it's 21.3 basis points. So 0.213 or 21.3 basis points from inversion. But we have a strong economy, and there's no signs of recession. So this is the yield curve inversion, recession. This is the yield curve inversion, recession. This is the yield curve inversion, recession. But there's yield curve inversion, recession. But there's no sign of yield curve inversion or recession right now. None whatsoever. Even though the curve is already inverted on every time frame, except for the 210, 510, and 3 month or like short term. But the 510 was just inverted, wasn't it? Yeah, the 510 just inverted the other day. It might not still be inverted, but it was literally inverted and then flattened back out to even, and then I think technically it uninverted like slightly. But you get situations like this where it basically inverts on inverts, inverts on inverts, and then we still end up in recession. So it's all the same in the end. All right, so let me jump over and chat. What's going on with you guys? Say what's up if you are listening, if you're enjoying the stream, if you have any questions, and then we're going to jump into some asset requests. I had a few today from the group members. All right, let's keep going. Guys are quiet today. Maybe a little too quiet. Let's do crypto. All right, so Bitcoin futures chart still below 200 exponential and simple. 200 simple has started to roll back to the upside with our little move back up. So still bearish technically, but trying to stop the 200 exponential. In order to reclaim this trend and be bullish again, we need to start closing above 45.7. We have momentum on the daily in our favor with the blue slope line on the TJD TDMACD. Basically getting some choppy mixed signals on the Jewel Thief. It's going to be very unreliable right now because we're basically just chopping sideways for like months. But here we got the 821 cross up, then down, then up, then down. Then, I mean, this thing's doing squats. So we just got to cross back up. So what we don't want to see is another lower high. What we don't want to see is a rejection below 45,600. What we do want to see to be bullish is take out this high, take out that high, take out the 200 exponential and simple, consolidate, and then we probably put in at least a nice move back up to revisit all-time highs, if not new all-time highs. So that's what we're looking at. So this was us confirming into a bear market. Don't mind these blocks right here. I was using that for an example for something and just never deleted it. This was us confirming into a bull market. This was us confirming into a bear market. This was us confirming into a bull market. Why is this so important on the daily? Well, if we just bought the bull market move right here, you know, from the bull market move to the top was 158%. From the bull market move to the bear market, which technically a gap down on futures, that was 50%. If we got in here and got out when this told us to, we avoided that Rona dump, which was 48%. So we made 50%, then we avoided 50%, and then we basically just got back in again around the same level because this was our bull cross again. So the first bull cross was 50%. The first bear cross saved us a 50% loss. The next bull cross, you know, and you can buy anytime before then. You don't have to wait for the buy signal. You can start getting back in. Once you've saved 10, 20, 50, I mean, you can get back in whenever you want. So from the next bull cross to the next bear cross was 416%. So as far as like the simplest, easiest thing to do, I mean, you just trade the daily bull cross, bear crosses. So right now, there's no reason to be bullish in these markets. Now, once you take a look at that though, and then you decide, now I'm going to start messing with the 8s and 21s. Well, once the bull cross happens to the upside, you want to buy the dips. So every time we sell off, you want to buy either the 200 exponential and simple moving average, horizontal supports, or rebuy at the 821 cross. So then with the 821 cross screen right here, we buy. This is all upside. Then when it crosses red, we sell. This is all downside. Then it crosses up. That's all upside. Here's downside. Here's upside. And then obviously, since that last cross, so apparently this is what I was demonstrating. You know, that's downside once again. And then again, you know, this is just a little chop. So there's not really, I mean, there's not much going on right here. We can see that this is just getting less and less useful as we basically just chop around sideways. But, you know, the 821 on the daily, I would say that's pretty effective if it gets us in every big move and out of every small move. Now, granted, here, you could say, well, we're bullish because 821 crossed back to the upside. But we should be selling rips, not buying dips. So the whole way up, we were buying the green levels because that was aggressive moves to the upside. That was us buying the dips for moves to the upside. And then once we broke down below, we should be selling rips. Now, arguably, we could still sell these. Like, I still got out of Bitcoin at, I think it was like 60. I can't remember. You'd have to go back and look at the video when I told you I was getting out. It was 68,000 or 60,000 and then 50, I think 6,000 right here at the cross, 58,000. And then we got back in right here on triple bullish divergence. So we had triple bearish divergence, got out of Bitcoin. We had triple bullish divergence, got back into Bitcoin. We rebought the 200 exponential right here. We got back out again, back up here off of bearish divergence. Closed my position at 62K and then basically been net negative ever since. And then, you know, took a couple little scalps along the way here. But, you know, as far as I'm concerned, there's not a ton of price action to be had right here. So what I see for a potential downside target is essentially the 382 in green right here. What I see as potential upside target is, you know, that measure move in blue right there, which would basically just be a breakout and move back to the upside. But either way, you know, I think we probably end up with downside target. The difference is this B already in, or, you know, and that's it, and then we're just going lower? Or are we going to push up higher, get bullish, and then we go lower? But the way I look at it right now, there's definitely a much higher probability that we go lower than higher. Much more likely possibility that we go lower than higher right now. So we'll see. You know, technically though, you could say, oh, we're bullish because the 821 crossed up on the daily. Sure, and I wouldn't be mad at you for doing that. But after two little chops in a row like this, I'd rather just wait it out. And again, you know, what is the difference? Well, 13%. And you're like, well, 13% is a little, I don't want to pay that much to see if I'm right or wrong. I'd rather just, you know, take my chances. That's 100% viable. If you have a nice risk reward setup or you have a reason that you want to be bullish in these markets, there's nothing wrong with that. There's nothing wrong with that. As long as you can figure out a place lower than that where you're sure you want to be out. Like if we break down and close below the ascending blue support, that's 6%. So you could say, well, it's like 1 or 2 to 1 risk reward ratio. I'm bullish. I want to protect myself. I don't have any Bitcoin right now. I'd rather have some just in case. I could get behind that. I could get behind that. I don't think you'd be crazy. But when we look at the weekly, again, it's just ugly. We did get that close on the weekly at the 8, which is good. We like that because that was the first step. That was one of many. The next is to get a close at the 21 at 43.8. And then we can start looking bullish. We did get a hard buy signal right here. Last time we got it, though, we were already well above the 8 and 21 cross back to the upside and looking much more juicy. Right now, this looks just like a little limp bounce. A little bounce. Rejection, rejection, rejection. Another little limp bounce. Higher low, though. Higher low. Higher low. What's up? Guess we'll see. I guess we'll see. And we did obviously spot some pretty clear daily bullish divergence between these points. I would love to see another drive of bullish divergence or bearish divergence to give us some kind of confirmation one direction or the other. Because right now it's just kind of choppy. Kind of choppy, especially on the futures chart right now. And then Bitcoin spot chart. Again, very similar. You know, we keep getting rejected. This is like a pretty hard rejection at the exact same level. So we kind of have that triangle going on, that ascending triangle, depending on if we were going by, you know, a flat top or wicks. And then obviously we have the green ascending support right here versus the blue one. But essentially we're just operating inside this channel, triangle rather, for now. So until we could break out this triangle in one direction or the other, which again, maybe we get that retest of 200. We fell short of it every other time. So maybe we push up to 44,600 and then we finally get the rejection that we need and we can go lower. Or maybe we burst through it and then we finally put in a new high at 48,400 and we go higher. But until one of those two things happens, you know, until we do something, it just looks like we're just going to chop. What was that thing? The slap chop? Looks like we're just going to slap chop it up as seen on TV. So Ethereum, this was our, you know, parabolic resistance. We broke through it, came back down, found support. Here's our potential measure move. This was where we were talking about a potential entry from that level with targets to the upside if we broke down below this level. Obviously, we're lower than we were then when we talked about this before, so not looking particularly great. But again, the risk reward like 3-1, even better now. It's holding support, starting to build a little bit of strength to the upside. We are printing some bearish divergence though on Ethereum. That does not look good. And Ethereum is just a dog lately. And it's not like a good, like cute little dog. It's like a dog with some string hanging out of its butt, like trying to like rub it on the carpet. You know what I'm saying? Where you're like, man, I love you, but what the fuck are you doing? I mean, we have a high right here. We have a lower high right here. And then when we look at the stochastics, this is our high and this is our high. I mean, we have used substantially more energy on this drive, and we are, I mean, like literally at the same or lower. Now it's possible this finds support and then pushes up, and this wasn't actually a high, and there's no divergence. No, I said there's no divergence. It's possible. But if we get another red candle, another negative, this is going to look like some pretty nasty bearish divergence on the daily. You know, and that dog might need to go to the hospital, if you know what I'm saying. Solana looks like trash. Just cruising to the downside. Never made it back down to our target, unfortunately. 821 looking likely to cross the upside. Failed to cross here, failed to cross here. Potentially going to cross right here, but literally just selling back down to it. Momentum in its favor. Man, I mean, what is going on with Solana? Did the cult die? Did they just lose all their money? Are they trapped? Yeah, there's no trade here. I mean, the risk reward is terrible on this. And it looks like it's probably going to go down. Avalanche had a nice little push to the upside, all the way back to our descending resistance. Got rejected basically exactly at it. I mean, still looks okay for now. For now. Don't fuck this up, Solana. I mean, Avalanche. Yeah, I mean, it's probably topped out for now. We'll see. I mean, that was the way to that was the place to short right there, obviously. I mean, in hindsight, of course it was. Right at the resistance that we've been watching for months. Of course it was. So what is this? Do we need to redraw this? Something like that, maybe? Or at least put in a second one there for see where it comes down to. We'll see. See, I wish this would respond a little more clearly to the horizontals instead of just all these random ascending and descending ones. Yeah, there's nothing here. I mean, the alts all had like, if they had a good run, they're done now, and they made it exactly to resistance. If they didn't move at all, they just look like trash right now. And most of them, like, it's because they already moved up and they don't have anywhere else to go. Matic is trying to cross that 821 back to the upside. Technically broke down from resistance, depending how you draw it though. Maybe it was supposed to be how we had it before. Maybe this was supposed to be resistance. I mean, it looks more like it now, doesn't it? One touch there, a wick right there. Not quite a wick right there. And then a rejection right there. This is probably how people are looking at it. I mean, but this thing is just getting wedged. This is our ball just to, and then it's just going to break aggressively in one direction or the other. Is it going to break to the upside? I mean, technically, probability says yes. But, I mean, realistically, let's be real. Nobody cares about Matic. It's all about what happens with shitty bitty. $2.15 though. I mean, at this point in time, do you just risk it for the biscuit? I mean, realistically, this thing probably just stops you out and goes lower. Let's be real. But it's like 4-to-1 risk reward ratio. Oh man, freaking Matic. We crushed it on this thing so many times, and now it's just been melting down lately. I wonder if it's time to take a stab at the old Polygon. I am Mormon, so polygamy right up my sleeve. I'm not actually Mormon. I'm just joking. So if you're Mormon, no offense. And also, high five. Very nice. So yeah, maybe. I don't know. Maybe there's something there for Matic. We'll keep an eye on this one. If we get even a slight close above this after so many touches in a row, I'm going to probably take a momentum play on this just because the risk reward is just so thick and juicy. We did see a little bit of bullish divergence between, I mean, we basically had triple bullish divergence between these points, these last like 3 points, and then nothing happened. So what's up, Matic? Let's all enter the trade and then go share it on all the forums. I'm just kidding. I feel like that's what all the crypto influencers do. They're like, oh, it's super bullish. I already bought X random shitcoin. So go pump it up everywhere you can. Luna, still just consolidating at that same level. Reclaim the 8. You know, probably the best crypto. It looks like this thing's ready to take off. I mean, honestly, it's just hanging out at the highs, going sideways. Looks like a bullish reset. It looks like it's fueling up, getting ready for new all-time highs. It really does. I think realistically, the easiest way to just kind of put a target for where we think it's going to go is just for the, you know, without getting too crazy. I think we just take that high right there and that low right there, and then just look at the 1.618. I mean, it probably goes to $180, which is 100% from here. That's on a breakout, if it breaks out. I mean, it could literally implode tomorrow, like Squid Game scoring or whatever. I have no idea what this is. Whoever asked about it, you probably know. Maybe I'll look it up one day, so I'm forced to stop saying that. 164 to 180 would be the target to the upside if it was going to break out to the upside. Target to the downside is probably the 382. So, I mean, is this another one where it's just, I mean, you could obviously just run a tight stop loss and just take an entry wherever. But, I mean, the target to the downside is 67%. Target to the upside is what, 100%? So, it's 1.5 to 1 risk reward ratio. And obviously, you wouldn't have to just sit there and take that. I mean, you could take a pretty, 17.5% stop loss. It's a little further than we like to see, but with the 96% upside, 5.5 risk reward ratio. I mean, there's an argument to be made for it. Definitely some potential. If I was in a position on this, I definitely wouldn't be selling out just yet, if you know what I'm saying. And I mean, realistically, if you just wanted to run it super tight, you could say a close. Now, you'd have to be careful of a wick. I wouldn't be leaving any resting stop losses. But you could run a manual stop loss with a close below 85.73, which is our lowest close so far since that swing low. And if it closed below that, take your 6% hit and get out. But if not, I mean, you're just in a momentum trade to the upside, looking for that, massive move. Which realistically, I mean, just to retest the all-time highs is going to easily put you at a 1-to-1 risk reward ratio, let alone the frickin' 16.1 risk reward ratio. But it probably just goes to 0 tomorrow. So obviously, this is just for entertainment purposes only. Theta. The old Theta. Yeah, I mean, just this resistance is just crushing it. I mean, it's consolidating at it, though. Every other time it got smacked down. So what's going on? If Bitcoin could just grow a sack. I mean, crypto wants to break out so bad right now. It's so crazy. It's like all the bulls are just absolutely dead, or they just don't have any money left. It's freaking pathetic. Where are the bulls? Did people stop recruiting new cult members? Is the cult dead? Where's Tom Brady at? He needs to stop playing football. Is that why he unretired? Did he lose all his money in crypto? Like a fucking noob? Oh, damn it, Tom. I don't know. We'll see. 33% upside. 10.5% downside. It's exactly where it was before. Nothing has changed. So that's still it's still the same play. You know, it's a 3-to-1 risk reward ratio. If you were going to take it. So how about some flux? Let's look at the old go fluck yourself. So if we just take from the bottom back here, this is on KuCoin. If we take from the bottom at 7 cents to the top at $3.35, we are basically just hanging out at the 236. So holding on for now. I mean, obviously, we're seeing some clear interactions along the way. Here at the 618, at the 786. So it looks like this is probably bot-driven top. I mean, this is a pretty solid support. And it's also 200 exponential and simple. Man, honestly, this thing looks like it's ready to let go. Looks like it's coming down to the 382 at 43%. Downside. Yikes. We could put in, I mean, this thing had an epic run, obviously. Looks like it kind of already broke out of that resistance. This was like a pretty hard resistance. Broke out, found support, and now just kind of consolidating and going sideways. This is technically, you know, I mean, maybe it's ready to rip. I mean, it's definitely good that it held that level. But once it held that level, why didn't it get any kind of upside potential? You would think it would get a nice move, and it looks like it basically got the move and then just got sold into. So probably some people came late to the party and are stuck in this thing. I mean, it's down over 50% from the all-time highs. The 200 simple is crossing above the 200 exponential, but still above them. This is, I mean, it's basically, this is like do or die time for this thing. Let's see. A stop below that previous low at like 13%. A retest of the previous close right here is 33%. So there's an argument to be made for a 2.5x move from here, or a 2.5 risk reward ratio from here rather. Do I have a bullish or a bearish bias on this? I mean, technically it's crossing the daily 821 back to the upside. It has momentum in its favor. The Stochs look like they want to move up here. It is holding the 200 exponential and simple. And then what would be like the big, thick, juicy play to the upside if it just went absolutely nuts and it was just like, oh yeah, you want to be bearish on me? Go fluck yourself. I mean, I would just throw the fib from the high down to the low right there and then basically look at that as, let's switch this one to orange. I mean, it basically would be looking at, yeah, the 0.5 is that previous high right there, and that's our 33% move. And then a move up to either the 618 would be 51%, 786 would be 81%. So if you're running just a 13% stop loss, which is pretty juicy, and I would not want to put it in the books, I would want it to be on a close because this was a pretty aggressive wick. But if we close below $1.26, I wouldn't want anything to do with this because it's just going to look like continuation of downside, where we have a high, a low, a lower high, a lower low, a lower high, and then another lower low. And it's just going to look like we're going to keep going down. If we take an entry from here, though, and we break above this, which realistically, you know, we have like this little breakout above $1.54, we probably head up to 382, which is $1.71. If we head up there, there's no reason we don't head up higher, which is probably $1.90. And if we make it to $1.94, you know, call it $2. So that's probably another 33% move. So, you know, 2.5 to 1 risk reward ratio here, or 6.3 to 1 risk reward ratio there. You know, but again, I mean, this thing could go Squid Game coin or whatever, or like, you know, completely just go to zero tomorrow. And you're like, oh man, Flux went to zero, dude. Go Flux yourself. That's the worst joke ever. But seriously though, I have no idea what this is. So. But it was a request, and that is the old flux. The old flux capacitor. If it drops 50% overnight, you're going to wish you had a DeLorean so you could go back in time on that one. 7 cents, though. You're probably up massively if you're interested in that thing. Or you're down 50% from the highs if you were late to the party. DXY still chopping around here at the highs. Probably goes lower. Hard sell signal. Bunch of red histograms. Super bullish on this thing still, but I think it heads back down to 97.25. Tesla breaking back above 200 exponential and simple at resistance, retesting those key levels. I believe that was our target. Yeah, the red descending channel, and then also this little purple guy. So again, that was probably options driven stuff. I didn't look at like options activity, but it was probably massive on Tesla. Alibaba at resistance after that quick little pump back up there. Baidu, I went pretty deep in these the other day, so I'm not going to worry about them. Baidu, man, what a blow off top right there. That looks like a pretty hard rejection. Looks like it is a, I mean, we see one right here, we see one right here, and we see one right here at the 200 exponential and simple. You know, we basically see a shooting star rejection, which, you know, obviously a candlestick is the least reliable. A candlestick pattern, slightly more reliable. And then, you know, obviously like momentum, more reliable than that. So this has momentum against it, but it has a candlestick reversal to the downside as well after a pretty aggressive move to the upside. I mean, like 50%. And basically at the 200 exponential and simple. So did this top back out? Is China about to capitulate? Doesn't look great. NEO back on top of the 821. If it crossed the 821 back to the upside, it probably does go back up to like 30. So it could still be like a 50% move in the cards for NEO. Some bullish divergence as well from these 2 points right here. Man, I'm super skeptical on NEO. I mean, I've been skeptical on this thing the whole time from when it was like $54. You know, I've been bearish on this for a while. I think I got real bearish at about $40 and was talking about how it was like $1.50 and China basically nationalized it. So careful on that one. Diddy had that big move back up. Looks like it's going to try to reclaim some key levels. We'll see what happens from here. It's at resistance, so it probably rolls over and then finds a higher low. ARKK, 3 white soldiers back above the 821. Is this thing ready to have a Kathy Wood back to the upside? 94%. Could you imagine Kathy being up 50%? Going from a loser to like less of a loser, but up 50%? That would be huge for her. She'd be back on CNBC. She'd stop crying on interviews. She'd be like, I told you so, motherfuckers. I'm rooting for her. SMH. Semiconductors got the move back to 200 exponential and simple. Off some bullish divergence. Probably rolls over and goes lower here, in my opinion. NVIDIA looks much more juicy. You know, basically that continuation breakout potential trade. Closed at the high again. Momentum in its favor, bullish divergence in play. Probably does get that measure move up here. I think it's like a 23% move. So it looks pretty good. If it closes below the breakout, 7% stop loss. So I think we put the stop at 243, the entry at 264, where we're at right now. And our target is 322 for the measure move. Probably going to run into some pretty serious resistance around 291, but it's still a 3.2 to 1 risk reward ratio. Netflix maybe gets that massive push up here, 35% with 13% stop loss, bullish divergence. Gonna have a little trouble getting through 408, but that's a pretty hefty gap though. And people would definitely FOMO into Netflix, I feel like. Apple, damn near at resistance, probably one of, if not the strongest of the big players. Breakout for Apple, new all-time highs, if it gets there. Holding support for now, holding 200 exponential and simple. Microsoft back here, trying to avert the cross down, retesting 200 exponential and simple. Breakout from this level is going to look like a W, double bottom. Nice, said it correctly the first time. With a target of 333, which is going to be a 10% move to the upside. God, this thing has just been going sideways, huh? But it's going to invalidate the head and shoulders, so that would definitely be good. That would look good for Microsoft. You guys know, obviously, I am a big Microsoft bull. And NVIDIA, obviously. I mean, I've been through this a million times. You guys know what I like and what I don't. Amazon, so had a nice move to the downside, but now here we are back here retesting 200 exponential and simple. Again, if Amazon breaks through this level, it's probably going straight back to the top of the channel because we have pretty much a double bottom and we're at the neckline now. So while I don't think it happens, I mean, I wouldn't put it past Amazon at all. But I've been pretty clear. I'm not shorting Amazon. I'm actually looking to buy it lower, which apparently is just never going to happen. I mean, obviously in hindsight, should have just took the entry off the back of the channel. bottom of the channel, but looked pretty shiny back then too. So, I mean, 12% though, that's nothing. Shit, 12%. I don't even get out of bed for 12%. Google, the old googly poogly. Same thing, just trying to reclaim 200 exponential and simple. I'm really just got to see what plays out here. Little bullish divergence, like triple bottom action. Where does it go from here? No clear. I mean, same thing. I guess if Google breaks above where it's at right now, it probably does have a nice move off of like this little push. Something like that. Back up to like 2960. Da, 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 da. Gold. Let's look at the commodities real quick. Metals. Gold is closing below the 8 and 21. You know, as long as the markets are risk on again, gold is the ugly cousin that nobody cares about. I look at this great opportunity to be accumulating when it's much lower. You know, I know a lot of people are FOMOing in at like over 2,000 at new all-time highs. How many times did I literally say I would rather wait until we actually get new all-time highs with the close? And now here we have pumped all the way back up to the new all-time high. We're all the way back down at the all-time high, and gold just gave back another 7%. I mean, that always sucks because the premiums are so high when it's going up. I would always rather buy gold when it's going down and have it keep going down than buy it when it's going up, because they just tax that ass on the premiums. And it looks terrible. Hard sell signal, sell by sell, spike top, bunch of red histograms. Oil reclaimed that level. Energy looks much more bullish. And then metals just look like a dirty old shoe. Oops. Silver. Barely reclaiming 200 exponential. Reclaimed the 200 simple, but has not flipped the slope back over. Sell by sell, divergence signal. A bunch of red histograms. Doesn't look good. Silver really needed to hold that heart line. That's all it needed to do. But if it holds 24 to look good, again, if you're not positioned in silver and you like silver and you've been wanting to get in silver and you've been putting it off, you know, I think your chances when it's at like $24 and going down, because the premiums are getting lower. Because honestly, if silver is going down and you buy it at 24, you're probably going to get it cheaper than if it's like going up and it just bounced off like 22, because the premiums just start going through the roof as soon as it starts looking bullish again. So, you know, with silver in particular, the premiums are just so ridiculous. Even if silver outperforms gold, you probably still would do better on gold because the premiums on silver are so ridiculous. Especially things like eagles. I literally would never buy an eagle ever at the premiums they're at right now. It is just absolutely criminal. Absolutely criminal. I would be buying like Britannias or Krugerrands or, you know, Maples, basically anything. There's no reason that eagles should have an additional 100% premium over these other, you know, government issued rounds, in my opinion. I mean, maybe you're like, yeah, but eagles in America because freedom. Okay. If you take a eagle and put it next to a Britannia and you say which one of these is a nicer coin, I mean, I hate to say it, but the Britannia is just beautiful. I get it, though. People don't want the queen on their silver. Whatever. Who cares? XAU to XAG, gold-silver ratio. Looks like we're going to get the weekly cross back down here. We'll see. Might avert it, but, you know, it's going to tell you that silver is a better thing to have than gold. We did see a pretty big volume spike right here. Obviously, wait, was it? It was triple witching, but when was that? This is the weekly chart, so that was a few weeks ago. So I don't think it was commodities futures this week. So I wonder if that was the close of the commodities futures. Damn, I should have paid attention to that. I honestly didn't really notice that massive volume spike or like put two and two together, but that is pretty beast right there. Quite a bit of volume. I wonder if that had to do with that weird silver stuff going on. Yeah, it's like not even, who cares? Anyway, pot stocks, THCX back at the 886, trying to build some momentum. The third drive of bullish divergence and a little bounce. I think I'm probably just going to go ahead and add to my position down here. Probably not of THCX, maybe. Probably of ACB, Tilray, Hexo. Yeah. I mean, at this point in time, I think a couple years from now, they're going to be much higher. And the truth is, they're probably going to have like a 30 to 50% move. And I'll probably just take a bunch off the table right then. I mean, if the realistically, let's just say, for instance, we get the reversion of the mean play and a retest of the 200 exponential. If we're at 7 right now and it goes to, 1070, that's like a 50% move to the upside. So if you opened a, for simplicity's sake, $100 position and then it went up to 1072, you would now have $150. I would just take my $100 back off the table and then just let the other 50 ride and just leave it alone. So it's a break-even trade, but now you have, a nice position open for free. And then after that, you can see what happens. That's how I would do it, or will do it, or are doing it. CCJ back at the highs here. I mean, uranium just trying to get juicy. Hard sell signal, left the bullish control zone at the highs. This is like a triple top right here. Still has momentum in its favor. Man, is this thing about to roll over? It probably is. I really wanted to see this go lower. See, the 200, this is the thing about uranium right now that has me super skeptical. The 200 crossed above the 200 exponential right here. And then a lot of times we'll get a pushback up to a new high, but then it will roll over and then it will go much lower. But the 200 exponential is picking steam back up again. So this is very close. If the 200 exponential crosses back above the 200 simple, this is going to look pretty bullish. But as long as the 200 simple is still above, I don't love this right now. And uranium has just come so far so fast, and it just never does anything. I could see this thing going to a new high and then just going sideways for like 2 years or down. Copper, CPER. This is the U.S. Copper Index Fund. This is like triple top status right here. 1, 2, 3. Does it go higher from here? 200 simple is above the 200 exponential. 200 exponential looks like it's going to try to cross up here. It has consolidated for quite some time. I mean, maybe copper and uranium and all these commodities do go higher again real soon. And then gold and silver come back up too. Man, I just don't see a world where commodity prices are lower in the future. Not short term anyway. A lot of volume coming in on these last 2 candles to try to save that cross. Oh man. These are some tough charts right here. Woo. If I wasn't positioned already, if we didn't get these at much lower prices, I think it would be easier for me to be bullish on these things. But, I remember what they were costing a year and 2 ago, and they're just at ridiculous prices. Platinum is trying to reclaim the 200 exponential and simple. This thing really needs to push back up here and stop being, a little underperforming bitch. It really does, because it's going to start looking terrible soon. I mean, it can only break so many times. The weekly looks pretty good, though. Man, I wonder if it's time to just jump in on the old fatty platty trade. God, look at that monthly candle. Picking up momentum, reclaiming 200 exponential. Rejected off the top of the channel. I mean, if this thing closes above 1220, it probably like doubles in price. 2098. Now, granted, this is, I might be getting a little creative with this chart, but the way it interacted on that heart line so many times, and then obviously we really only have like one touch right here, but we have a bunch of touches, on the top. They look pretty good. So maybe we don't get the actual measure move. What about an internal retracement? So we're not just like fantasizing. about metal, about hard blocks of platinum. I mean, the 886, I think 1960, realistically, probably the 786 would be our target since we just hit the 618. 1713, I could see that. I mean, this thing has underperformed for so long. That's probably what we're looking at, ladies and gents. And by ladies and gents, I mean gentlemen and bots. 65%. Yeah, we'll see how it plays out. I mean, it looks okay. Probably does go higher from here. And palladium, it spikes low, it spikes high, it's back at the moving average. Same thing as copper and uranium. I mean, it looks almost exactly the same as the copper chart, honestly. Like shorter term, it's like a triple top basically. Looks bullish though. But this was a aggressive run from, I think it went to 0, didn't it? Went down to 880 and now it's back at 2540. I thought there was some sort of regulatory agency that like regulates market manipulation and like, you know, crazy volatility in metals. I guess not. I guess there's nobody in charge. Didn't Congress just get in trouble for buying a ridiculous amount of, and by in trouble I mean exposed, but in no trouble, for buying like a ridiculous amount of defense stocks? A little Raytheon in your portfolio right before you're you know, cheerleading for a war. That's convenient. Honkiness says, feels like this week is important. Right on the cusp. Yes, it is, my friend. Right on the old cusp. Is the Bitcoin triangle a bear flag? I mean, I look at it more as a Bitcoin triangle. You're talking about it's like an ascending triangle. Which technically a bear flag would be a descending triangle. So I think it's more like a pennant, honestly. Oops, wrong chart. I would look at it more as a pennant. Sorry, you probably asked that question like an hour ago. Because we have like a long lead in. And then you could either go by close and have an ascending triangle, which is like higher lows and like a flat top. Or arguably, yeah, I mean, you would have to kind of have it as, I mean, it looks it looks more like an ascending triangle, depending on what exchange you look at it on or what time frame, to tell you the truth. So I would probably call it, I would probably call it a pennant, honestly. That's what I see when I look at it, but it is a little bit ugly and it looks a little different on different time frames. You know, spot versus futures market, etc. So, but I mean, I wouldn't like invalidate it. I wouldn't say it's not possible. Technically, a pennant is usually like a little more of like a symmetrical pattern. I don't know. Could go either way. And typically, if you get like an ascending triangle or a descending triangle, it will typically be ascending in a bull market and descending in like a bear market. So it's a little bit more like in line with the actual trend of the market. But I don't know. I mean, you could call it. You could. The thing about a bear flag is that a bear flag is more like it's more like a channel. So like a bear flag would be if this broke out to the upside. Okay, because we basically have a lead in and then a bounce and then a higher low and then a higher high and then another higher low and then a higher high. And we start actually forming, let me just delete all this for a second and then hopefully I'll remember to put it back. If this was going to be a pennant, it would be, you know, let's just go by closes so it's just more clear. If it was going to be a pennant, it would be more like this. It would basically be us just finding support at higher lows consistently and then putting in higher highs, which isn't, it's not that like that's impossible by any means, because the push to the upside takes us back to key resistance, which is the ascending triangle, you know, that flat top, which is a 200 exponential. And then a break above that takes us to 200 simple, which is the top of what would amount to, you know, a pennant. And then, you know, could it keep chopping around inside there for a little bit? Yeah, definitely. I mean, it could easily just do, you know, one of these guys. Which tool do I want? I think I want the pen. You know, basically just do something like this where it just chops around inside here. And then, you know, for who knows how long, and then eventually puts in a lower high, or maybe it even breaks out here, but then eventually typically that will break and you'll see continuation to the downside. There's a lot of ways it can play out. And that's why this is really like big indecision, because it's very close. It's, you know, there's no clear pattern that it has to be right now. It's basically just what happens next. If it breaks out here, it's going to look like a very clear ascending triangle. And then at that point in time, it's like, okay, it probably does come back up here, and then it probably is a bear flag. You know, which it's going to look bullish, and then all of a sudden it breaks down, and it's like, wait a minute, that was supposed to be bullish. Oh, man. So we'll see. We will see. You know, and sometimes we got to just let the market develop a little bit and tell us what's going on, because that's how I kind of feel right now. Is it's like the market is, damn it. I hate that tool. The market is basically waiting to tell us what's happening right now. And it's like, all we got to do is just be patient. But it's super close to just revealing itself to us. But yeah, I think that's going to do it for today. Appreciate everybody tuning in. Thank you to the new group members and all the group members for showing your support, because you guys make all of this possible. And without you guys, we wouldn't be doing our third weekly stream. So obviously, we are streaming every Sunday from 8 p.m. till 10 p.m. Every single Wednesday from 8 p.m. till 10 p.m. Eastern Standard Time. And then every single Friday, of course, from maybe 11 a.m. till 1 p.m., maybe noon, maybe 1 p.m. Who knows? No, I definitely had some stuff going on this week, randomly unexpected. But yeah, we will be live Friday at 11 a.m. Eastern Standard Time again. Wednesday at 8 p.m. Eastern Standard Time. And then the following Sunday, 1 week from today, at 8 p.m. Eastern Standard Time. So I appreciate everybody. Have a good week. Protect your capital. Don't feel that FOMO. Make sure that you have clear targets and invalidation if you decide to take a momentum trade to the up or the downside. Make sure that you are always being smart, keeping a trade journal, and looking for favorable positions based on probability of success, trading with the trend. Risk-reward ratio. You know, how many dollars do you got to give up to win how many dollars on a coin toss, even if it's just 50%. Proper position sizing. How many coin tosses can you afford to take before you take a big loss? If you take one big one and you're wrong, you get wiped out. If you take 10 and you're wrong, too many in a row, you know, you're going to take a big hit to your account. If you use proper position sizing, you could take 100 and it ain't no thing but a chicken wing. And a perfect example I like to use is if you have 10 positions in your account or 10 lots. So say you have $100 and you decide to take 10 $10 trades. Even if you take a 10% hit on one of your lots, that's a 1% loss on your overall account. It's nothing. So if you're taking 2-to-1 risk-reward ratios, you can afford to fail on multiple of those lots and take 1% hits, and it's like nothing on your account. 10% on that lot and a 1% hit on your account, and then you have 1 or 2 successful ones that yield you over 2 or 3-to-1 risk-reward ratio, and you still end up positive. So position sizing, risk-reward management, and probability of success are extremely, extremely important. And, you know, I nonstop preach the same things. I know you guys are tired of hearing it, but we got to build a solid foundation, or when the wind blows, the house is going to fall. But that's it for today. Hopefully you all enjoyed the stream. Thank you all for tuning in. I am Crypto Trend Trader, and that is our wrap-up for our Sunday evening market look ahead. It is 10:11 p.m. Eastern Standard Time on March 20th, 2022, and I'm out of here. Peace.